So again, we are learning about fraud, internal controls, and cash. And so we started off talking about fraud, right? So fraud has to do with intentional deceit in order to get some sort of benefit, right? It's tricking people, and not as a joke, but to get their money typically, right? And we talked about the fraud triangle, how there are three elements that have to exist in order for it to be fraud. So people can do other bad things, right? Not all bad things are fraud, but fraud will only occur if the person has some sort of incentive, some sort of reason that they want to commit the fraud. They perceive that there is an opportunity, that they think they can get away with it, and they can somehow rationalize it, because most of us don't intentionally do things that we think are wrong. There might be some people out there that do, right? But for the most part, whether it's because we don't want to get punished or we're just a good person, most of us don't want to go out there and be unethical. But if we rationalize it to ourselves and say, oh, well, it's not that bad, or maybe it's okay that I do this, that might be enough to get us to cross the line into fraudulent territory. So we talked about the role of auditors, both within the company, an internal auditor, and then somebody from outside the company that can look at the books and try to make sure everything's being documented properly, there's no fraud or mistakes. There should be an entire internal control system in a publicly traded corporation. It's required under the Sarbanes-Oxley Act that you have an effective internal control system, and you even have to audit your internal control system to make sure that it's operating properly. We talked about the different elements that go into an effective internal control system. We talked about some of the aspects of an effective system where, remember there was the example of the vice president who was writing loans and putting them in other people's names, but he was keeping the cash, right? So you want systems in place to prevent that sort of thing from happening. All right, we talked about Sarbanes-Oxley. That law came out in 2002. It was a major change for the accounting field. It put a lot of extra steps in the accounting process that a lot of people were unhappy about, but I think overall it has helped increase transparency, increase accuracy, and reliability of accounting information. Mentioned Enron, their stock price. We talked about why you want to have an approved vendor list, so employees can't just make up a supplier and then pay themselves and make it look like it's a legitimate payment, right? We talked about things we can do to protect ourselves against fraud. And then we got to petty cash, right? So petty cash is a different type of account, because once you establish your petty cash account, unless you want to change or lower the amount, you never actually make any journal entries in petty cash. Instead, at the end of the period, you just replenish, right? You take money out of the bank to put back whatever was spent out of petty cash. And there's a process, right? Well, you have to record all the petty cash transactions, but here's where you journalize the creation of a petty cash account. But at the end of the period, all of the expenses that were paid for out of petty cash have to get journalized. And then you take that amount out of the bank account, put it back in the petty cash drawer, right? And in this case, technically inventory wasn't an expense, it was an asset. That was the milk that we bought, but same idea. You still have to journalize that transaction and take that cash out of the bank account. Okay, questions so far? Anybody have any questions on anything? Okay, all right. Then sometimes at the end of the month, when you're checking to see how much petty cash you have in your drawer, cash on hand is what they call it. And then you add up the receipts, you find there's either money missing or sometimes there's extra money. So the account we use to correct that is this cash over and short account. Now, here we see that that account is being debited. So what do you think? Were we over or were we short if we're debiting cash over and short? Taking $5 out of the bank, so we were short. If we had been over, we would have extra money we'd be putting into the bank. So in that case, we would be debiting cash and crediting cash over and short. So that's the way you can keep them straight. Think about, are we taking cash out of the bank and our cash is going down, or are we putting cash into the bank and the cash is going up? Right, and if you need to increase your petty cash account, it's the same journal entry as if you created the petty cash account in the first place. It's a debit to petty cash, credit to cash. And so by that logic, if we're decreasing our petty cash, it'll be the opposite. Right? We'll debit cash, we'll credit petty cash. Because in that case, petty cash is going down, credit, and cash would be going up because the money we're taking out of the petty cash drawer, we're putting in the bank. So that would be a debit to cash. Right. I don't know if we got this far. Let's see. Okay, that's as far as we got. Exactly right. So that's where we'll start. Now, this petty cash process, as I mentioned, it's a lot more efficient than having to get approval to spend the money, getting a purchase order, making the purchase, getting an invoice, having a check cut. That whole process is pretty time consuming. So having the petty cash drawer is simpler. Cash is there, somebody's in charge of it. Somebody can go to the bank, use some of that money, bring back the receipt. At the end of the month, you just replenish petty cash, right? It's a much more efficient process. But here's a question. What if instead you just gave employees either a credit card or a debit card that they could use when they needed to make a purchase instead of petty cash? That would be even more efficient, right? You say, okay, here, you can take this card, go buy the milk or the birthday cake or whatever it is, and bring back the card and the receipt and the birthday cake. Any problems with doing it that way that you foresee? How do you control what they're going to buy, right? What if they never come back? What if they go book a flight, or who knows, withdraw money off the debit card? So there are ways to work with that. You know, some companies do that. They do have different kinds of payment cards that they let employees use, but you have to monitor it, right? You have to make sure employees are not abusing that process. Same thing goes for petty cash, right? You give somebody $100 out of the petty cash drawer. Again, what if they never come back? Or what if they tell you, sorry, I lost the $100. What are you going to do? Make them pay it back? So these are, you know, there's no perfect solution, right? There's always some risk involved. Okay, so again, we've talked a little bit about Sarbanes-Oxley. As I've mentioned, I think this is going to be review for you. The chief executive officer and the chief financial officer of the corporation both have to sign off on the financial statements. So that if there is any fraud that occurred within the accounting department, in other words, if the financial statements are not accurate and were intentionally inaccurate in order to deceive somebody, like the investors or lenders, the CEO and the CFO can be held accountable. They can no longer say, I did not know that there was a mistake in our accounting records. I did not know that we made ourselves look more profitable than we really were. Because they had to sign off on it. They also have to review the internal control report to make sure that their systems of controlling and preventing fraud or other bad things within the company are effective. All right. In fact, a CEO and a CFO can go to jail and or be fined if the company was found to have committed fraud. Now, does that mean it never happens? No, it still happens. Any questions? Any comments? All right, let's see. Okay, so imagine that your CFO in your company tells you, you know, this whole thing about CEOs and CFOs having to sign off on the financial statements, you know, that's silly. You can go ahead and just sign my name. And they say, you know, that thing about having to have an audit of our internal control system, let's not worry about that. I know our internal control system is okay, so don't worry about that either. What would you do if your CFO said that?
Oh, no.
Call the FBI? All right. What'd you say, Lewis?
Hell no.
To protect yourself, you might want to document what happened. You know, maybe refuse to comply. But even if you go ahead and comply, you know, send an email saying, even if it's to yourself, saying, this is what I was just told to do. It's not right, but I had no choice because it's my boss. And you know, I'm documenting that this happened. Now, that's not a perfect solution because you still were complicit. You documented that you knew it was wrong and that your boss made you do it, but you still did it. So blowing the whistle to an outside agency like the FBI or the SEC or any other appropriate law enforcement, yeah, that's an option. Some people are not comfortable with that. You could maybe go over your boss's head. Although the person over your boss might also think that you should commit fraud. You could go to HR. You could quit. There are a lot of things you could do, right? But if you do nothing, if you only obey the commands and don't protect yourself in any way, you could find yourself in jail because of what your boss made you do, right? And I don't think anybody would want that. Questions or comments? Okay, so then the next concept is bank reconciliations. We did go over that somewhat in the exercise set, so this will sort of be review as well. Again, the whole point is to compare the cash account in our ledger with the bank statement. Because they're probably going to be a little different. We have to make some adjustments, and once we make the adjustments, then they should equal, right? These were some of the types of adjustments. We might have written checks that the bank has not cleared yet for whatever reason. So we know we spent the money, but it's not showing up on the bank statement yet. We might have made deposits that also have not been processed by the bank. So like I mentioned, sometimes companies just drop off their deposit in the night deposit box. Or in some cases, they might even mail a deposit in, but probably not very often anymore. There was one case I remember reading about where This ties into fraud as well. Somebody dressed up as a security guard, went to the bank, stood outside with this official looking box. And when people came up from companies with these pouches full of money to deposit into the night deposit box, he said, oh, it's under maintenance. Go ahead and put it in this one. So they dropped their money in there, and then he just took it and all the money. I don't know if anyone could get away with that today, but at the time, apparently that worked. So, so anyways, just because you've made a deposit does not mean that the bank has recorded it, right? Hopefully they received it or will be receiving it, and then they'll record it, but in the meantime, it's considered to be in transit. Okay, then there might be things the bank knows about that we don't know about. Maybe they charged us some fees. Banks love to charge fees. There's some new legislation, I think it got passed, that, or maybe, I don't remember the details, but I remember hearing that the Biden administration is now limiting the fees that can be charged by banks. Because some of them get pretty carried away. You know, you make one little mistake and you get a fee, and then if you don't clear it up, there's another fee, and then if you don't clear it up immediately, there's another fee. So it's like the fees just keep adding up. So that might be something that we didn't know about until we saw the bank statement. There might be an NSF check, non-sufficient funds, where our customer wrote a check, we deposited it. Initially, the bank said, okay, you've got that money, but then they realized we didn't have the money because the customer didn't have the money in their bank account. So when our bank could not get that money from the customer's bank, they pull the money that they had credited back out of our account. And then we have to go in and do a journal entry. Which account did we update in that situation? An NSF check. Accounts receivable. That is correct, right? Because we need to keep track that that customer owes us that money. If there's an error made by the bank, we do not need to journalize that in our records, but we do need to include it in the reconciliation so that the numbers come out right. But of course, the bank should be correcting that error. It doesn't happen that often, but I've seen it. I remember one time I made a deposit to my credit union and they posted it twice for some reason. And me, being an honest person, I called them up and I said, hey, that deposit got deposited twice, but I only deposited it once. And they said, oh, you're right. And they fixed it. They took the money back out of my account. But, you know, I'd rather they take it out instead of me thinking the money's there and then later they pull it out when I'm not expecting it, right? Okay. And sometimes banks collect money on our behalf. A customer might wire money into our account, or they might pay money they owe to us directly to the bank if we've given them our banking information. So again, those would be situations where we learned about that from the bank. We're going to have to then update our records. We do that with the journal entry. And we'll also have to include that in the reconciliation. So here is an example. We are starting with a book balance and a bank statement balance. Who remembers where would we find that book balance? Where do we get that information? Which account? Cash. Exactly. We would look at our cash account in our records, and that is our book balance. And the bank statement balance we get off of our bank statement or the bank's website. So this is what it's going to look like. I think I can zoom in on this because we don't need all that extraneous information. Ooh, it doesn't quite fit, but we'll start with this side. Okay, so in this bank reconciliation, on the left side, we start with the bank statement balance, right? And then we need to make any adjustments that we know about, but the bank does not yet know about, right? So the bank doesn't know about this deposit. And the bank probably doesn't know about this particular error, right? Until we bring it to their attention. It's possible that maybe they didn't know about it when they made the statement and they have since corrected it. But obviously, if they knew they were making an error, they wouldn't make it, right? So, so anyways, we do have to adjust for that so that our reconciliation comes out right, but we are not going to journalize any of this information on this side. All right, so we're going to add the deposits that are in transit. We're going to add that correction that the bank's going to make. And that gives us this amount here. But then we're going to subtract the amount of these checks because we know that when those checks clear, that money's coming out of our account, okay? We're going to subtract that, and that gives us our adjusted bank balance. Are there any questions on the bank statement side of the reconciliation? All right, then let's look at the book side. Farther. Okay, so again, as Yannette told us, we start with the amount in our cash account, right? That is from our books, and that is our book balance. Then we add any money that was collected on our behalf by the bank. Subtract any NSF checks that came out. This was a recording error that we made where depending on what the error was, maybe it's adding money to our account, maybe it's subtracting money. So here to correct it, we have to take money out. And then here is a service charge. Okay, so these would all be things that are coming out of our account. Now, as all of these things on the right side, we have not journalized. We did not know about until we saw the bank statement. So we're going to have to journalize the money we received and these as well. Now, is it possible for us as a company to bounce a check? Could we write a check and then it turns out we don't have sufficient funds to cover that check? It is. However, in this chapter, anytime you see NSF check, that's not what it's talking about. It's always talking about a customer. Okay. Any questions on that bank reconciliation?
So when you do this, these adjustments, that if you're checking your bank statements at the end of the month, every daily, you would just be making big.
You could do a bank reconciliation every day if you're logging into the bank account. But if you're waiting to receive a statement once a month, then you do it then. But it would be the same process if you did it daily. It would be based on what does your bank account say is your balance as of that day. So a company that has a lot of transactions, they might do a daily reconciliation. So as I said, we would then journalize these transactions on the right side, not the ones on the left. So this just shows those getting journalized. I don't think we have to go through that level of detail. I think you all kind of get it. We've done exercise 9 already. We've done exercise 6 as well. All right, so now we are up to actually more discussion of Sarbanes-Oxley. So any questions here on bank reconciliations before we move on? Okay. All right, so let's see. You might have heard this phrase, cooking the books. If you are intentionally putting inaccurate information in your accounting records, that's cooking the books. It's a violation of GAAP, and it is illegal, right? So you don't want to do that. You might have heard of companies having two sets of books. One that they show maybe to the tax authorities, but another one they show to their investors or something like that. Well, that would also be illegal. You shouldn't have two sets of books, because obviously they're not the same, right? So one of them is wrong. You should only have one set of books. It should be accurate, thorough, GAAP compliant. In fact, that's one of the things, there was a case that was recently settled in New York. The state of New York sued former President Donald Trump, alleging that when he provided information for tax purposes on some of his properties, he would give one piece of information so that he would pay less taxes. But that when he would give that same property's value to a lender, because he was trying to get a loan, he would give a different valuation. Something for this, and very different, like 10 times different. And that's what the courts ruled. So it's not my opinion. That's what was ruled, and there was a judgment against him. Anybody know the amount of the judgment? Anybody know the amount of the judgment? About, well, before interest, it was about $350 million, and another 100 million of interest that has accrued since these, falsifications occurred was added. So it's almost $500 million that Donald Trump has been ordered to pay to the state of New York for those crimes. Ouch. Pretty big bill, right? And that's on top of all of his other legal woes. So yeah, don't cook the books. Not worth it, right? And that actually was a civil case. Even though it was coming from the state of New York who was suing him, they didn't sue him in criminal court. And I'm not sure, but I think the reason is that it happened too long ago, that it's outside the statute of limitations, or perhaps they didn't feel it was. I'm pretty sure that's what it was, because I think if it did go to criminal court, I think they'd have enough evidence to convict him. And in that case, he could go to jail for that particular crime. But since it went through civil case, there's no possibility of jail for that. But there is the fine. So again, don't cook the books. Okay. And why would companies do that? Well, in his case, he was trying to get money from banks. He was trying to get loans that he really didn't qualify for, or trying to get people to invest. But if they knew that his assets weren't really as valuable as he said, they probably wouldn't invest, right? So it was fraud. Sometimes companies do it to get their stock price to go up. That was not the case for him, but it was the case for Enron. It was the case for WorldCom. They were trying to make their stock price higher. Because when investors think a company is profitable, they're willing to spend more money for the stock. If they know that the company is not profitable, then they don't want to buy the stock, and the price of the stock goes down. Oh, we're at the summary already. Wow, it's so early. Okay. It is what it is. We might be finishing early today. Is that okay? All right, so we've learned about the fraud triangle, right? For fraud to occur, there has to be opportunity, at least the perception that there's an opportunity to get away with it, the incentive, and the rationalization. Companies should have both internal auditors and external auditors, right? The internal auditors will hopefully catch any mistakes or fraud first. But anything that they miss, the external auditors should catch. And the external auditors can certify that the financial statements have been audited by an external party.
Your CPA would be considered your external, right? Or we
Yes.
something that.
Yeah, no, a CPA can be an external auditor. Now, they don't all do that. They don't all provide that service. But yeah, typically an external auditor is a CPA. All right, and what else? We talked about you need to have a system of internal control, make sure that things are not getting stolen, there's no fraud, and so on. That includes having clear responsibilities, who's responsible for what, having clear documentation of how things are supposed to be done, having adequate insurance so that if there is fraud or theft or hacking or anything like that that occurs, it could cost so much money to fix it, your company might not have enough money. And even if it does, it probably doesn't want to spend all that money. So having insurance to cover those things is sometimes required, but even if it's not, it's a good idea. Separate duties so you don't have one person that can authorize, like authorize writing a check, but then also write that check for themselves, right? So you want to separate it so one person does the authorization, a separate person actually writes the check. So it's two different people. And make it clear who's responsible for what. We talked about how you can use petty cash as a way to keep track of small purchases and not have to go through the normal process of getting a check approved. We talked about SOX, Sarbanes-Oxley, and how that's designed to keep executives honest, make sure that there are internal control systems to protect whistleblowers, to specify what the fines and criminal sentencing guidelines are for executives that commit fraud. All of that is covered in SOX. Now, that was in 2002. It was only 6 years after that we had our next wave of major scandals when the 2008 financial crisis hit. When we have a major economic downturn like that, a lot of frauds become apparent. When everybody's making money, it's easy to hide the crime. But once the money dries up, your investors start coming to you, say, hey, where's our money? Then the crime gets exposed. And that's what happened with Bernie Madoff, Tyco, and so many other large frauds. Okay, so we talked about petty cash, talked about that. Oh yeah, that was SOX. So that's where I was going. So around 2008, 2009, I think it was 2009, the next legislation was passed to try to prevent corporate fraud. That was called the Dodd-Frank Act. And that came to us by Senators Dodd and Frank that came up with that legislation, and that further tried to prevent fraud. But there's still people out there committing fraud, right? They're always going to find a way. Especially now with things like artificial intelligence and just as technology improves, they come up with new ways to commit fraud. Question? All right, then we learned about bank reconciliations, right? That is an internal control process because you can check and make sure you have the right amount of money in your cash account, in your books, and in the bank account, right? If it's not matching up, if you go through the reconciliation and they're not matching up, some money is missing somewhere, right? So then you can dig a little deeper and hopefully find the missing money. There was a situation here where there was an employee who had the authorization to make certain purchases on behalf of Hartnell over Amazon. They had access to Hartnell's Amazon account to make purchases. They made more than $10,000 of other purchases on that Amazon account that were not for Hartnell. and then claimed, oh, I got it mixed up. I thought that was my account. More than $10,000 worth of these purchases. That's not a mix up. And they were prosecuted. I don't know what the eventual outcome was. I can tell you they don't work there anymore. But these are the kinds of things that can happen. So that's why you want to reconcile, right? Somebody took a look at that Amazon account and said, hey, there's something fishy going on here. We didn't purchase, dog food, for example, or whatever it was. We don't have any dogs on, that we take care of on campus, at least not that I know of. Okay, and then again, financial statement fraud can occur if a company is trying to hide some illegal transactions, or just trying to be dishonest about their profitability, right? There are companies that sometimes do illegal things, like money laundering, right? Who can tell me what's money laundering? Familiar with that phrase? If somebody's making money illegally, it's hard for them to spend that money, right? Like, for example, let's say somebody's working for a drug cartel and they're getting paid in like suitcases full of cash. Well, if you walk into the bank with suitcases full of cash, they're going to be very suspicious, right? So what do you do with that money? Well, money laundering is when you take money that you got illegally and use it for now a legitimate transaction so that you can transfer the money out of there into a bank and make it look like, oh, that was clean money. And really, you got it illegally. So, for example, one way you might do that, I'm not trying to tell you how to money launder here, but this is what you have to watch out for. Let's say, let's say somebody came to me and they wanted to buy a life insurance policy that was going to cost $20,000, and they wanted to pay me cash. And I was licensed to open up a life insurance policy. I would be suspicious. Why are you paying me cash for this? And it could be that they want to open up the policy, give me the cash, I open up the policy, and then they, a month later, cancel the policy and get a refund. Now they have a legitimate payment from a legitimate life insurance company, and they can say, oh yeah, that was just a refund from the life insurance, right? When originally that $20,000 was something they made from something illegitimate. So that's called money laundering. And that's another reason companies might might have inaccurate financial statements because they're trying to hide where their money really came from. So there we go. We're done with the chapter. All right, any questions or comments? All right. Well, then we have some exercise. We have one exercise left to do, and then we have some problems to go over. So